Okay, welcome everybody. Welcome back to the show. My name is Chris Anselmo at Brookside Tax and Financial Group. Along with us, Tony Marlette Jr., who is a financial advisor and a tax preparer for Brookside, and Ed McMahon of the radio, Tony Shore.
That's me. I'm just here to laugh at your bad jokes, Chris.
Yeah, well, we got plenty of them. So, yeah, we even got a new
bad jokes are in.
We even got a new
Sure.
got a new baseball team, right? The Guardians. So that's a whole nother story. Well,
yeah.
So I don't know. I don't mind the name so much. I just didn't like that they caved in to the pressure. But I'm not even sure there was that much pressure. But anyhow, so
I like the name. I like the name, the Guardians.
Yeah, it's no longer the Cleveland Indians, the Cleveland Guardians. So
yeah.
So they can sell a lot more merchandise, right?
Oh, that's the other thing. Yeah, it's like when a player changes their jersey number. They
from 23 to 6,
right, or 24 to 8 if you're Kobe Bryant. You know, 8 to 24. Yeah,
it's just more merch they can sell.
So today we thought we'd talk a little bit about, because of what's going on in the economy, what's going on in the world, about protection. We see oftentimes, points in your life that you use. You want to protect. You want to protect your house. You want to protect your car. You want to protect your life. You want to protect your income, disability, all kinds of things like that. So I did a little slide. Hopefully it'll show up. I'm going to try doing this again. So let's see if I can share the screen, and I will go to my little PowerPoint thing.
There you go.
And hit F5. Can you guys see that?
Yes.
So this is pretty rudimentary. It's my one-page PowerPoint. So
wow, this is it, huh?
Yeah, this is it. So, people, I get so hung up on annuities and protected investments, either buffered products or some type of things like that. So the only way you can really get true protection is from an insurance company. They're the only ones allowed by law to offer protection. So, we have in every phase of our life, we have auto, home, health, income. We even, I think we even have long-term care, and they probably should have put up there. But, if you want to protect your auto, what do you do, Tony?
You get auto insurance.
And if you want to protect your home from burning down, what do you do?
Yeah, you get homeowners insurance.
And if you want to protect your health,
you get the good old health insurance.
And if you want to protect your income,
I think disability insurance would be the correct answer there.
And if you want to leave a legacy,
nothing like some life insurance.
So, so people buy those routinely, no second thoughts about them. But how would you not have your home insured, right?
Right.
So, but when it comes to investments and savings, they're really hesitant about using insurance products, and maybe they just been brainwashed from the banks all these years. And Tony's an ex-banker, but I'm going to try. So I think people have seen this, but I'm going to try and get out of this so I could see myself. But let's see if I could do this. Okay. So, I think people indirectly use the insurance at a bank. Tony, you've been in banks for years. Mm-hmm. That little FDIC insurance thing sells CDs, sells bank accounts, because people are, they're have the reliance on that. Well, it's insured. So,
right. And what a lot of people don't realize to that extent, Chris, is, the FDIC is to cover you if the bank were to go out of business. So the chances of that happening are not nearly nowadays what it is, say, if you were to need protection on your investments if the market goes down. We talk on our market updates about 3 corrections per year and preparing for up to 3 market corrections per year. So you're not trying to protect against every single one of those so you don't lose anything. It's more about taking a portion of your assets and protecting it if you no longer have the time frame or the risk tolerance to put up with the volatility. But to your point, with the banks and all the other types of insurance, you have about a 1 in 300 chance that your house is going to catch on fire.
It's probably less. I know millions of houses around town. How many fires are there, right? So
right.
But you're right. They do
that. Is common too. Yeah. So I mean, you prepare for that, and it's your own financial future that you're protecting.
And I don't know what the hang up. Maybe Tony, you talked to a lot of other advisors. What's the hang up if people don't want to use insurance for their investments? I don't understand it.
Yeah, it's just not been as common of a thing, and they don't think that way. They've been trained to think that that's money for growth. They don't view that money the same way, and that's why it's because it's been pounded into their head. What have you heard when you ask somebody, what's your largest asset? What's your biggest asset? Everyone would say their house, probably, or the people I know would say my house. And the guy telling,
or their 401k, right?
Yeah. Well, that's my point though. My neighbor who I have a guy on my street has a lot of money saved for retirement, probably more than anyone I know. But I asked him what his biggest asset is, and he said his house. That's why people don't view their retirement assets the same way they do. His house is not his biggest asset. His biggest asset is his retirement savings, right? Because he's got IRAs and 401ks that add up to, a few $1,000,000. His house, I happen to know, is worth about $400,000. Right. So why is he saying a $400,000 item is his biggest asset when he has assets worth over $4 million or, $3 million, whatever it is.
Yeah. And like Tony said, that the odds of something happening to the house are much slimmer than the odds of the market going down.
Right. Right.
So, I mean, and then there's a lot of people have homeowners insurance, and bring this up to them. Like if your mortgage is paid off, you don't really need to have homeowners insurance, right? I mean, nobody's forcing you to have homeowners insurance, but you would not take that risk for a few $100s a year not to protect your house.
Right.
So I don't understand the hang up for a lot of times when we approach people, say, hey, why don't we use this ABC insurance product that's going to pay you a reasonable amount of interest instead of a CD? Why not use that? And they're like,
and protect you from losses.
Yeah, right. Protect you from losses.
So it's like insurance from losses. So it's like insurance for your retirement savings.
Right. So you could either use it as a substitute for the bank products, or maybe partially a substitute for bonds, or a substitute for some of the money you have invested in the market, because the markets, Tony does our updates every weekly or monthly, and it's been pretty volatile the last.
Yeah. And I mean, one thing that we've been talking about in there is how you used to be able to, if stocks are volatile, you used to be able to go into bonds as a safe haven, though that's not really the case. I don't want to say anymore, but certainly not right now.
It hasn't been for a long time, for quite a while either. And it doesn't look like it's going to get any better anytime soon.
Correct.
And for the listeners, it's purely because interest rates are so low.
Right. Yeah.
If bonds are paying 4, 5, 6%, have at it. But when they're paying 0.25%, why would you not only take the investment risk that the rates will go up, the insurance risk, the rate risk, but they're not paying you anything. So it's a double whammy.
You factor in inflation and your real return is even lower.
Right. And inflation, the self-imposed inflation, I hate to call it that, get political, but a lot of it's been self-imposed. Like when you affect the price of gas, it affects everything, right? It affects all the product, movement of all the product. It affects people going to work every day. A lot of this inflation's been self-imposed by the administration, whether you're for them or against them. I think everyone agrees. So, but maybe we'll get beyond that. Maybe they'll open up some of the reserves, and we'll get somewhat back to normal. We can't blame it all on Russia as we'd like to, but
right.
So Tony, what do you products out there? What do you been suggesting for people who want to protect some of their either get money out of the bank that's paying them 0.25%, or protect some of their investments?
Well, you mentioned my new career as a tax preparer before, so
he's doing.
Congratulations, by the way.
He's like, what have I got myself into?
I think our first actual day of tax prep, I told Chris, nice knowing you. I appreciate the opportunity. He asked if I was coming back the next day.
Yeah, first day. I go, you coming back tomorrow?
No, but in all honesty, I've seen a lot of people come in with 1099 or 1099s from CD interest, and they're $25, $30 that even if you roll over a CD to another CD, you're still paying taxes on those what is now realized gains. So not only are they paying you very little, it's taxable every time you roll it over. So what I've been trying to tell people as an alternative, you get more. We have a solution where you get more flexibility as far as what you're able to actually draw down from the solution. So for example, with a CD, if you take out $1 from a $25,000 CD and it's before the period is up, you're going to pay a penalty. It's going to be a very small penalty, but you have one no matter what. With our solution, you have access to 10% of it every single year without any penalty.
And you're probably getting 10 times the interest.
Well, right. And you're also either looking at it one of two ways with the interest. You're right. 10 times the interest is pretty much literal. And it's pretty
if you
accurate.
can get 3% and they're only paying you 0.25% at the bank,
Yep.
I don't get it. But
Yep. And then also we other strategies would include being able to participate in the upside of what the market is doing and none of the downside.
right. Yeah, we've seen some of those and some of these buffered products that have come out recently where you have some protection on the downside, but you have a much greater upside potential. So those are alternatives. If people are worried about, maybe you have a protection 10% down or a 15% protection on the way down, at least it gives them a little peace of mind that I'm not out there blindly in the market. And if the market does drop 10 or 15%, because I think we have a study, Tony, you probably even have it there about that chart we have, like how many times has the market gone down 15% over the last 100 years? It's probably only half a dozen times, maybe 10 times. So,
Right.
So I think people are more concerned about that it's going to drop 50%, but it doesn't happen that often.
No.
I think the last two times I can recall is either the housing crisis or 9/11.
Right.
Those are pretty big events to make it drop that much. So,
Right. Yeah. And it's been interesting to see people's reactions to when we tell them what this is. We'll go through I don't focus as much on wording or the name of something as I do the features and how it can
Right.
help somebody. But then afterwards, when you tell them this is a fixed annuity, they're kind of surprised.
yeah.
And
I
and that goes to what you guys were saying before about how, the media and Ken Fisher and whoever else has just, beat these things to death and
Susie Orman.
yeah, her too. And kind of successfully. If we're being honest, they've been very successful at it. I don't know why, but people think annuities have to be expensive. Ours, as long as they're fixed, you don't have any cost. As long as it's a fixed that provides a solid floor, you don't have any cost affiliated with it. Plus, you get the tax deferral, a little bit more liquidity than a CD, and better growth opportunities, like Chris was saying.
Yeah. And they're not for everybody. It depends on your financial situation.
Absolutely.
You guys aren't that's not a flat out everyone who comes in, this is the answer, because some people aren't in a situation where a fixed index annuity is going to help them. And you are going to look at what's in their best interest, whether that is a fixed index annuity or it is maybe they need more money in the market because their time horizon, or maybe they need something else, or maybe a CD is okay. But I know that it is a really great vehicle, and they've made so many improvements on these annuities. But you've got people like Susie Orman and Dave out there, Ramsey. These are two people who are not financially certified in any way, shape, or form. They are not financial planners, but they get on the air, TV or radio, and they talk about financial planning, but they're not held accountable by the same fiduciary standards and things like that. They're not CPAs. They're not certified financial planners. They're talking heads. And so they're talking probably about variable annuities that can have high fees and that do lose money. And so there's different types of annuities. And I think that's where the misconception, I just wanted to jump in there because that's where I see the misconception with annuities happening.
And I remember in Susie Orman's book, she actually said she likes fixed or index annuities. She doesn't like variable annuities for the cost and things like that. But, I think people just don't think about insurance when they think about investments and how it could protect their investments. I mean, you use it in every other phase of your life. If there's a product that can help earn a reasonable amount of rate or reasonable upside and protection, I think it's worth a discussion. I mean, whether or not you do it or not, it should be just another arrow in your quiver to move forward, because people, like I said before, people don't mind a roller coaster when it's going up. They start screaming on the way down. So if you can have some type of protection on the way down, maybe the roller coaster isn't so bad, right? So, Tony, what have you heard about the markets this week? Anything you want to share there?
Yeah, well, last week, I mean, we had the best weekly market last week since November. So, and actually, it might have been November of 2020. So, we actually had a really good week last week. This week, we had some metrics as far as durable goods orders, unemployment, continuing job claims. So, durable business orders, which is usually an indicator of business spending, has been down quite a bit, which maybe may not be a strong indicator, but we have still a really tight labor market. So I think the point is, I think people are looking beyond some of the macro stuff going on and saying, okay, the markets are still, our economy is still strong. Company valuations are still strong. They're still profitable. I don't understand how we can have such low unemployment and continuing claims if people say nobody's working. So there's got to be some kind of disconnect there. Yeah. But otherwise, I think, the markets continue to follow fundamentals. I do expect, and I tell people this, I do expect there to be more volatility. I know Gradient they keep stressing the same thing. They expect volatility for the rest of this year. I wouldn't be surprised if we end the year slightly positive to slightly negative overall in the market, but not without some serious volatility in the meantime.
So there are some strategies in some of these index annuities to grab a low volatility index, so that maybe when we think it's really going to be volatile, you grab that index and kind of temper it a little bit. But yeah, for the most part, I think people are warming up to it, but I think they just haven't heard about it. And annuities, the word annuity has gotten such a bad press over all the years. I wish they would change the name of it, so that people wouldn't. Be upset.
Well, I find it almost laughable when people are afraid of annuities, but yet, give me my Social Security or my pension.
Yeah, those are all annuities, right?
Just a big annuity, yeah.
You put money in, and you put money in over a certain period of time, and then you get a set amount back throughout your retirement. I mean, that's what a pension is? That's what Social Security is. That's what a fixed index annuity is. Those are annuities. I mean, it's just annuities that I think there's too many people who are just salesmen, insurance salesmen, pushed annuities on people that shouldn't have gotten into them, like a variable annuity, and made promises that they couldn't keep. And people got into bad situations with certain types of annuities that weren't right for them. Right.
Or they put too much of their money in any one product. Right. You
can't put everything into a variable annuity and expect to end up okay. And I think that's, for a while, it's been a number of years, but that's what happened to a lot of folks.
And I think people got pushed into even index annuities, but they put all their money in it and they didn't have any money on the side, where, I try to say, look, just put money in there that you don't think you're going to use for the term, the 5, 7, 10 years, whatever it is. Sure. And leave enough money at the local banks that you won't really have to touch this money.
Yeah, right? You have to have a certain amount of daily liquidity, right? Or at least monthly.
Well, for sure. And that's why we have concentration limits too, as far as how much of your overall assets can be.
But I think in the past there's been some, and there always is, some unscrupulous people in this industry. The little old lady has $300,000 and they put $299,900 in it and leave her $100 in the bank, and then bad things happen. So So I'm going to have to cut this short because I'm getting a knock on my door that a judge is on the phone. I'm supposed to talk to her about some guardianship hearing. So,
Okay.
So again, if you guys want to get a hold of us, Tony or myself, the number is 440-886-3550, or you can go to our website. Tony, you got that little fancy thing you can put up on the screen?
Oh yeah, the banners.
Yeah, look at
Yeah,
that.
there we go. How about that?
Hey, look at that. It's almost like we know what we're doing here. But I can tell you we're better at the financial side than the technology side. So, okay, well, look forward to talking to you guys next week. And
All right.
see you soon, guys.
All right.
Thanks, guys.
See ya.